Hi and hello everyone, and thank you for joining us. Welcome to today's session, an investor viewpoint, how startups can overcome challenges during the COVID-19 pandemic. My name is Guy Franklin and I'm the Managing Director of SOSA NYC Innovation Hub, which is operating the Global Cyber Center of the City of New York in partnership with the NYCDC, which is the New York City Economic Development Corporation, with the goal of transforming New York City to become a global leader in cybersecurity. I'll say a few words about the Global Cyber Center. The Global Cyber Center of the City of New York acts as the official hub for all stakeholders within the cybersecurity industry. At the Global Cyber Center, we offer curated cybersecurity programming, such as cyber corporate innovation, which means connecting between corporates that are looking for innovation and technology in cybersecurity, and we connect them to startups from our network. We work also with governments and cities. We have specific programs with them. And even now, with this challenging situation, we developed a specific program for cities and connecting them to innovation specific around cyber and domain security, smart cities, sustainability and well-being, healthcare, and digital health. And with the current situation, we've been proactive at SOSA, and we transformed 100% of our activity to online. Today's event is one out of a series of events that we are doing in order to provide value in these challenging times. Today we will discuss how this crisis affects founders and investors from Silicon Valley, New York, Tel Aviv, and the global startup ecosystem in general. We will talk about funding for startups, how to ensure your business continuity, and share some tips for overcoming this period. I would like to mention our partners for today's event. Bank Leumi, a partner of SOSA NYC. Leumi is supporting the startups from our community from day one, from the inception of SOSA New York, startups that are expanding to New York City or the Valley, or the ones that are already operating here. And we have today with us Ori Kaufman, Head of International and Tech Banking at Bank Leumi USA, who will be the moderator and will lead the conversation. Our second partner is Zag Sullivan, an international law firm with offices in Tel Aviv, New York, Boston, and more, specializes in tech, biomed, and capital markets, and is a partner of SOSA NYC also from day one and providing value to startups from our community. And actually, thanks to them, there is a smooth landing pad for startups when they are expanding to the US or already operating here. Our panelists for today, I'll just mention them like in one sentence. I will let Ori do it in depth. Dovi Francis, founding partner at Group 11. Dovi is also one of the main shark investors on the Israeli version of the reality TV series Shark Tank. And John Soberg, managing partner at MS&AD Ventures. MS&AD are partners at SOSA, which means that we are working together with MS&AD in finding technologies based on MS&AD needs, pain points, and challenges. We already got so many questions from the audience prior to the webinar. We try to embed some of it in the questions, and some will be answered at the end. At the end, at the last 10 minutes of the webinar, we'll have 10 minutes for Q&A. Before we start, just to feel the audience, we have 2 questions, live poll, so you will have 15 seconds to answer. The first questions, which you will see in a second, is where are you joining us from? Please answer, and we will see the results soon. You have a few more seconds to answer. Okay. Let's see the results. Okay, so 64% at the East Coast, 15% West Coast, Israel 15%, Europe 6%, interesting numbers. And the second question that we will see in a second on the screen is what size is the company that you are working for? Just also to see and to feel who joined us today. So let's give this a few seconds as well. And we'll see in a minute the answer. Okay, 45%, 1 to 10 people. And then there is a kind of same percentage on top of 500 and more, 21%, which this can be big corporates and so, but 45%, and that's great to see because this webinar is exactly about how to, what startups should do and the perspective of the investor. So it's great to see that half of the people 1 to 10 and even more than 10 to 50, which is also mean that there are startups. So without further ado, let's first welcome Kaufman, our moderator, which will also present the panelists. And thank you all for joining us and enjoy the panel. Thank you. Ori, the stage is yours.
Thank you. Hi, everyone. It's great to be here, and I'm not as professional as Guy in those kind of webinars. This is actually my first time on Zoom hosting a panel, so bear with me. My name is Kaufman Gafter, and I'm heading LeumiTech USA for Bank Leumi USA. And thank you, SOSA, for enabling this opportunity for us today. Bank Leumi USA in the tech space is providing commercial banking services to Israeli-related companies as well as US tech companies throughout our teams based in New York and in Silicon Valley. And I'm personally here in Palo Alto today. Thank you all for joining this webinar. With me in this zoomside chat are two close partners of ours and very dedicated investors to the Israeli tech. Dovi Francis, funding partner with Group 11, and John Soberg, managing partner with MS&AD Ventures. I'll let you introduce yourselves. Dovi, let's start with you, please.
Hey, everybody. So good afternoon to those of you in New York and in other territories. My name is Dovi Francis. I'm the founding partner of Group 11. Group 11 is a financial technology-oriented fund. I think one of the most active financial technology investors in the Americas right now, invest predominantly in enterprise software financial technology-related companies, which we're considering as category-defining companies that are around their Series A, although we do a lot of seed deals as well, business-to-business oriented, focused in Silicon Valley, so domiciled in Silicon Valley, although 70% of our portfolio is Israeli related. And we'll tell you more as the conversation ensues. Thanks, Ori.
Thank you. To you, John. You're muted. Yeah.
That would help. Hi, I'm John Soberg. I'm a managing partner at MS&AD Ventures. MS&AD is backed by a large insurance company based in Japan with operations in 47 countries. We are also very active we're a separate venture fund though, 120 million based in Palo Alto, and we invest all over the world. Focus mostly on fintech or things related to insurance, and quite active. We've actually done 30 investments in the last 18 months, mostly seed and Series A. And I think the other unique thing about us is we're quite global. So we have investments in Asia, Europe, US, Israel, nothing in Latin America yet, but we're open to it.
Thank you. So I'll start with the first question, and this is actually coming in a different version from many of our audience today. And I'll give a bit of a background. I've been looking at the numbers for Q1 investments this year. And there is a moderate decline, about 11% of the big rounds. And I assume this is only the beginning. So we know from previous crises that, for example, the 08-09, that pretty soon after the crisis, we saw even a 50% decline in investments. And this brings me to the biggest question to both of you. And we'll start with you, John. Are you open for business? Are you looking for new companies, or are you only investing in your current portfolio companies?
So we're open for business. I will say, to be totally just frank, we're slowing down our pace. So we're being fairly selective. We always syndicate our deals too, so we don't usually lead. And I think with the pace slowing of everyone, I think that will be sort of the norm. I will say I closed the deal on Friday. It was already in process before some of the COVID-19 hit. But I guess to kind of make it very simple, we're prioritizing our portfolio and follow-ons first and trying to make sure that those companies can survive. And then after that, we're looking opportunistically for, good things that are going to come along. But I don't think if you look for the next 6 months that our pace will match the last 6 months.
Yeah, that I would agree. Dovi, what about you? Business as usual out there in LA?
Well, let me see. Yes, I have my disinfecting wipes here, Clorox, and I have a hand sanitizer.
I can give you this one. Do you want?
So business as usual. So listen, I want to start by saying one thing, and to everybody who's listening to us, I think we have like 150 people. Take whatever I say with a grain of salt. It's only my perspective, and it's only John's perspective. And we are obviously biased. We have our own kind of like the way we see the universe. So my answer is not a collective answer that represents the venture capital community by no means, right? Some of them are locked in the basement. Some of them are like me, are at work. I'm actually at the office, and to each their own. But let me share with you kind of like how I see things. I think it's important to answer your question by looking first and foremost at the industry, and just from above for a second, okay? So remember, the 2018 and 2019 were record years in fundraising for venture capital funds. It's important to mention it, right? Because when you look at the numbers, and actually we follow those reports quite closely, there is about $1.5 trillion of dry powder right now in the venture capital universe. That's thousands of funds, right? We have 1,800 funds in the Americas. There are about 3,000 funds, 2,940 something funds globally, right? And many of those funds have raised money over the past couple of years. That includes Norwest that raised a huge fund. It includes Sequoia and Recent that raised a $2 billion fund. That includes even SoftBank, right? So just giving you some names just to remind you that lots of money has been raised recently, and that money needs to be invested. And let me explain to those of you who are not venture capitalists, we are conduits of capital, right? So we have taken money from investors, right? Some like John have taken it from one investor. Some like me, I've taken it from 140 investors. I guess I wasn't that lucky. And our job, we're mandated during the investment period to invest, to deploy the capital. Investment period is 5 years from the onset of the fund, from the activation date of the fund. So that's $1.5 trillion. Even if zero money was raised by venture capitalists in the next few years, that $1.5 trillion needs to be invested. Otherwise, why the hell, and I'm being polite here, why the hell are we charging management fees, right? My management fees are kicking in regardless of this crisis. So it behooves upon me to invest. So I just want to say that just kind of like, to put it above everybody, because money needs to be invested period over the next couple of years. So that's number one. Number two, money can be invested in better terms than before because the market has cooled down. So this has become a buyer's market. It's a good market for us venture capitalists. We can buy existing portfolio companies of ours so we can invest further, right? Vis-a-vis defensible rounds or new financing rounds, and buy more of the companies at a better price if indeed the companies require financing. And we can invest in new companies in better terms that we would have otherwise. So that's, I just want to say it out there. And I want to say two last things. One, we're open for business, we're investing, we're going to deploy. If you look at February, March, going into April and May, so 4 months, it's going to be about $20 million, or it because you have our lines of credit. You have all of my my personal and business checking accounts. So you see how much money is coming in and you see how much money is coming out. So Ori can actually testify. I'm not BSing. So that's one thing. The second thing I want to say, the lights are dimming. It's becoming, I don't know why. So the second thing I want to say, and I'll turn on the lights in a second. Over the past few years, anybody who had a pulse and access to investors could have raised money and called themselves a venture capitalist. I think what's happening right now is great for us. The good venture capitalists will survive. Their portfolios will continue to excel, right? Because we have invested fundamentally in great category-defining companies that will continue to excel despite of this blip on the radar, right? But people who were not good, momentum players, people who raise money for no apparent reason, people who call themselves venture capitalists, will be eliminated from the market over the next 12 to 18 months. So I think this is a great time for us, putting aside the human crisis, and which, by the way, in my opinion, is going to go away over the next couple of months. But putting aside that, I think that we are going to continue upon the renaissance we've been in. And remember, the European Renaissance lasted for 8 years. So we are just on the onset of man-machine symbiosis and renaissance in digital technology. That's it. I'll stop here. Let me turn on.
So I would want to ask a few more questions about your investments because this is of an interest to many of the audience. So John, have you made any changes in your focus or your due diligence? For example, are you looking for companies to present to you how they can manage their budget versus how they can be growth hackers? Are you looking into their special plans or amended projections in light of the situation?
Yes, so I guess I would say first, I've also, in the next, couple years, I think that we will see this, this will be a dip, and we'll see that move past us. But, my focus for the last couple of weeks has mostly been, I guess maybe triage is a strong word, but in some cases it is triage with companies that have to change their plans to adapt to the new reality. So I'm kind of, eye deep in working through these operational changes and plan changes and fundraising changes with, I've got 33 portfolio companies. So it's kept me fairly busy. But it clearly impacts the way I think about investments going forward. So if you had a plan that was, put together end of last year and you had projections, those projections aren't valid at this point. So, we've been talking to our portfolio companies about default alive plans to make sure that you make it through this, depending on how long it lasts and how long it affects your market. So if somebody's going to pitch me and they're not bringing a default alive plan or a plan that tells me how they're going to make it with, if corporates are sitting on their pocketbooks for the next 6 to 12 months, then it's not a really investable plan. So I do encourage people to try to be as realistic as they can about what this market looks like and, be patient. I don't, clearly we can see a light at the end of the tunnel, but if you're not showing us the tunnel part of that equation, then I think it's going to be hard for us to make that investment.
Yeah, thank you. And Dovi, it's funny. I'm not remembering that the first time I hosted you on a panel was maybe 5 years ago. Feels like years. I don't know. First panel I hosted in the U.S. Different times, really different times. And when I'm comparing it now, we were seeing, a trend and growing valuations in the fintech space at that point. Now, I don't know if it's too soon to discuss valuations drop at this point, but if we are looking at history, we know that valuations dropped significantly. And for early stage companies, for example, we saw the exact number of deals. We didn't see a decrease in number of deals, but we did see, of course, valuation drop. And my question is this something that you're already seeing in your space?
Yeah. Okay, good question. So can I give you a tricky answer?
Please do.
All right. So let me tell you, the luxury of being an investor in the private markets versus the public markets is that you're not tested daily, right? You're tested on the outcome. So I want to say it to all of our listeners, right? Put the public markets aside and put the private markets aside. On the private market side, it depends if you're fortunate or unfortunate when something like this happens. Fortunate meaning that your companies are well capitalized enough not to need to raise money at this time and not to endure a down round, because I do believe that if you are an existing company right now that requires capital to sustain operations, you will get, pretty shitty valuations and stuff like that. So it's all about timing. And by the way, it has nothing to do. It has nothing to do with how good you are as a company. sometimes timing plays a role as well. So, you know, if you're an excellent company, but you're running out of cash and you have 6 months of runway, and we're in the midst of the crisis right now, and you need to raise money right now, we'll expect a significant down round, right? Just the way it is. However, if you're well capitalized, yes, you should reorganize yourself. You should cut expenses where needed, and so on and so forth. I'm sitting on 7 boards, and trust me, we've done our our COVID-19 plans already, and I'm just tired of talking about that. I prefer to talk about value creation and stuff like that. So the bottom line is, in the private markets, I think the tricky answer is that it matters and it does not. What matters at the end of the day is whether the company has become a category-defining company. Has it really managed to redefine its respective subcategory, its respective industry? And if that's the case, it will be a super valuable company, irregardless of what's happening now in the market. We tend to get this tunnel vision when a crisis erupts. I just think about the next 5 to 10 years. It takes 7.9 years on average for a company to exit from seed to completion. I need to bring them to the finish line. You know, I need to do my work, and this thing really kind of like distracts me because we keep talking about things that I don't think it really matters what the valuation is. By the way, even if there was a down round in the company, I don't think it really matters. Yeah, okay? I think what matters is the ultimate outcome, and that's my responsibility as investor.
Thank you. I want to ask a question to both of you, and we'll start with you, John. I've been speaking to a lot of startups over the past 2 weeks, and some were actually very quick to jump on new opportunities. So for example, a cyber company that's now focused on cyber for Zoom, which is obviously the new threat. I'd love to hear some examples, if you can share, of steps taken by your portfolio companies in light of the situation and the opportunities that it arise.
Okay. I think, you know, there's a few, you know, situations like this always affect people in different ways. We've got a couple of companies where this is actually probably going to move them faster. And, you know, they happen to be, so you mentioned cybersecurity. I have a cybersecurity company that was, they've always been focused on communication security, but where that actually took priority generally was phishing and email. And now it's moved much more to Slack and Zoom and collaboration tools. And so they happen to be well placed into this market. Their marketing has changed dramatically to be focused on the current issues that are coming up and the remote work. I have a company in Germany that was focusing on connecting people to doctors. And as you can imagine, probably pretty much all of their business went away in about, you know, a day or two. And they're now launching a telemedicine platform that they were going to launch in 2021, and they decided to move it up and do it in 2 weeks. So, you know, I think we've got some. It's always, to me, very humbling to work with founders that are so reactive and so quick to be able to adjust. And I think, you know, hopefully these are the ones that make it through these kinds of times. You know, we have some others where I think, like Dovi said, sometimes timing is amazing, and sometimes it's kind of terrible. If you're having to fundraise now, we're seeing a couple where, you know, they're kind of drastically cutting expenses to see if they can give themselves some additional runway, because right now a lot of investors are pretty, you know, all the board meetings are talking about COVID-19. So they're not really talking about making new investments, at least in the next couple of weeks. So you kind of have to get into a survival mode in some cases if your market has changed so dramatically or your revenue has kind of dropped off the cliff. But we're seeing people look at product changes. I actually tried not to have people change their product roadmap so dramatically if they don't need to. And even in the case of the medical company, she was going to do this anyway. We changed the product roadmap order. We didn't take the company and say it's going to do something different, because I think you want to look at what the post-COVID world looks like and adjust your plans to look like that. But I don't think you want to make rash decisions just to adjust to the current market.
Thank you. Dovi, any interesting examples that you can share with us for shifts in products or focus of your portfolio companies?
No, I just don't. Listen, I think if you had a shitty product, then you're probably, you're probably pivoting right now. I mean, if you have a good product and people stopped using it, okay? So let's talk about TripActions, for example. You're gonna ask me about that later, but TripActions is a portfolio company of mine. We're a very large investor, and they offer corporate travel solutions, right? For large, mid-size, and small enterprises. And that company has been growing like crazy, and Ori, you're familiar with that as well. Like 5x year over year, steadily over the past 4 years since the inception of the company, being actually the fastest growing software company in the Americas. And one day this thing comes about and nobody's traveling anymore. So, okay, bookings are down to almost zero, right? 95% drop in bookings, which by the way, you're seeing also in airlines and stuff like that, etc. So does TripActions need to change the product right now? Absolutely not, right? I mean, yes, we should be worried. We should be far more wary of our travelers' whereabouts, and that should be a feature that should be added to the product as we have done in recent weeks. But we should not change our course of action, right? Because in tandem, what we're seeing while bookings went down, new travel budget under management, new contracts that came into the system went up. So we're seeing actually faster adoption of the TripActions solution amongst new customers that haven't talked with us before because they had other solutions in the market. But guess what? Many other solutions in the market, and by the way, this example applies to many other markets, have evaporated. So now we're seeing a faster adoption of our software. And what I'm trying to say, this analogy, is to say that if you have a good product, you have a good product that withstands, a blip on the radar, a shift in time and stuff like that. I saw ClassPass just announced that they are moving to virtual classes. Well, okay, I understand the need, right? I understand the need. Nobody's using ClassPass right now, but if that was a long-term shift in their strategy, I would have been worried. Anyways, so that's that from my perspective.
So I'll dig deeper in this TripActions and travel in general. I'm sure that many on the line right now got the email from United yesterday. And for those who didn't see that, United were updating that they're maintaining our current status until January 22nd. Mm-hmm. So, it made me think they're looking at a pretty slow recovery. And the question that also we got from the audience over the weekend was, what's going to happen to travel? Is this going to change? I mean, are we going to go back to traveling? Is travel startups something that would stick around? The numbers, I know that this is not represented, but the numbers right now that we see is loss of 50 million jobs worldwide in travel, 3 months of loss of income. The numbers are scary. So the question to you is really about the industry as a whole.
Yes.
Dovi.
So let me tell you, I'm not an industry expert again, I'm a big investor in TripActions, and by virtue of that, I've learned a lot about the participants in the market. But let me answer you just common sense type of thing. To me, the way I view it, and I hope that many of the people in the panel agree with me, we can have a vote later. Human nature prevails anything else. And human nature is curious. People want to interact with other people. They want to enjoy life. They want to travel. They want to see different places. They want to sleep at great hotels. They want to enjoy great venues, listen to live music, and dine and wine. And that's my answer, and that's all there is to it. So I don't accept this working from home bullshit, okay? Everybody hates working from home. Everybody loves their family, but only for a couple of weeks, okay? Yeah, the fabric upon which relationships were built is that we don't spend 24/7 with our loved ones. And that's it. So now I can say, listen, will we see some reduction in unessential corporate travel? Well, yes, we'll see some reduction because large businesses, everybody's suffering, right? So large businesses will adjust their expenditures when it comes to travel. But guess what? We need to travel to close certain deals that have a high dollar amount. Like, you cannot do it over Zoom. There is a limit to what you can do over Zoom. So we're doing it right now, which is fine because we don't have any other option. But the moment the restrictions are lifted, I'm sure it will be gradual, right? On a state-by-state level. So some state-to-state domestic travel will proceed, and then we'll see international travel. with some kind of like a biometric, like a biohealth type of passport. I don't know. But the bottom line is, I think that I cannot measure how long airlines and hotels will continue to struggle. I'm sure there will be some bailout package that will be part 2 of the package that we've seen a couple of weeks ago that will help that industry. But I do believe that fundamentally all of us will go back to travel in full swing, and we'll see more of a U-shape, a V-shape type of bounce versus the U-shape.
Thank you. John, I know that us Israelis think that we are the center of the world, but you're actually investing in other countries. And I know you have investments in Europe, in Singapore, and India, and so on. If you can please share a bit of ways that entrepreneurs worldwide are coping with the new situations. I assume there are different challenges. Some are similar and some are different.
Yeah, it is interesting. Well, Israel is pretty much the center of the world, right? So we can leave that there. That's a separate topic. I think it's interesting because we did see adjustments come in different time periods in different places. So I would say Singapore was probably the first and most aggressive to act, but frankly, those startups have had to make the fewest changes because the government in Singapore was so aggressive on this. And in some ways, the Asian markets have seen less impact than some of the others. So, I think we've seen the consistent thread across all of the startups all around the world is that they're trying to pay close attention to the adjustments in their particular markets and then, change as necessary. So if they see enterprises slowing down their spending, then they're also changing their burn rate to kind of match with that. We do see revenue patterns slowing in most places. Stuff is just being delayed. I don't think it's necessarily that it's not coming through. Most of the cases that we see are enterprises that thought they would close in Q2 that are now probably going to be Q3, Q4 kind of thing. So it's delayed revenues. I do think the US has had to make more drastic changes in some cases. So I've got companies in Germany, for example. Germany seems to be one of the countries that's handling the COVID-19 pandemic better than other countries. So that market looks like it's going to come back faster. So the cuts have had to be a little bit less or maybe a little bit more gradual. So, what we're seeing is that people are following the patterns. If we see a sharp drop, we see the startups move faster or more aggressively, for example, in the US. And then it also depends a bit on the regulation. So, in Germany, you can put somebody on half-time and the government will pay the second half of their salary. So there's nice ways there that the government has actually got some backstops in place that are a little bit easier than applying here in the US for the paycheck protection or the loans that are, not so easy to understand or to get as quickly as people would like.
Thank you. Yeah, these loans are actually, we at Bank Leumi USA started, we're enabling clients to apply, and it's a big help for the industry, although there are other challenges when it comes to VC-backed companies, and I'm sure everyone's aware of that. So I have some questions from the audience, and one question that I think is can be very interesting is, do you have, and this is a question for both of you, I'll start with you, Dovi, any practical advice or tools that you can share with startups that are attending our Zoom chat right now, or any things that you are doing currently that can maybe assist the larger crowd?
Well, it depends where you are. I mean, are you raising an additional subsequent financing round, or is this your first financing round? So the answer is different to both of them. I think that, let me address the ones that have already raised money and are in the market to raise additional sum of money or just to weather the storm. I'm not going to give you all the regular, stuff, right? I mean, I'm not going to talk about reducing expenses. I'm not talking about laying off the people that you need to lay off in order to withstand the times and so on and so forth. I actually want to talk about resilience, and I want to talk about what your investors can do for you. So I assume that every founder that has raised money has raised it from a bunch of investors. Some of them are more institutional, some of them are mom and pop shops or angels and so on and so forth. I think it behooves upon your investors at this time to add value to you and not just to BS you and just to, to take your time asking for revised financial models. The time for revised financial models, the time for offense is long gone. If they haven't done it like a month and a half ago, I don't know what the hell they were doing. The time now is actually to help you win new customers, number one, right? To help you find new investors, number two, to help you retain key employees if need be, number three. These are the most important things to founders typically. So I think that, you need to demand it from your investors if they don't have the mindset, if they're not open enough, if they're, because people are people. Some people are just terrified and it is what it is. It's human tendency to be afraid of the unknown. But if they haven't woken up to offense already, remind them that the time has come to add value to the company in which they have invested their hard-earned money or their investors' money, and just to add value with those three things. And I can tell you that where I spend nowadays and you probably can see it on my Facebook and LinkedIn posts, and for all of the attendees, I actually shared with you some resources in the chat box. The time has come to really hone in on those things, and that's how I spend my time. About 60% of my time is just adding value to our portfolio companies right now, and that's through chats and our greater community, and that's through chats like this one, but that's also by making introductions to clientele. I'm doing it really actively with Tipalti. I'm doing it really actively with Trip Actions, with Sunbeat, and so on and so forth. So that's the extent of that. I'll give you one more thing that I've done recently, and then I'll stop. But we decided a couple of weeks ago that we want to connect with each one of the employees in our portfolio companies. So mind you, I have about 2,500 employees in our portfolio companies. We're connecting with each of them right now through LinkedIn, and each of them gets a personal message from me and some access to resources that we have posted. And the message there is like, we're in it together, right? We'll do everything to support you, whether you keep your job or not. And we look forward to staying in touch and adding value to you. And I think that's the mindset of that should be the mindset of investors right now.
Thank you. John?
Yeah, so I guess, I'll tell you. So I was a founder in 2001, and in early 2001, my investors who had committed to fundraising or committed to our next round pulled out. We were going to do a big round. We had 50 million committed, and that 50 million went to zero when the stock market really took a big hit. And so I personally got to let 350 people go basically overnight. So for me, it's one thing to go do these plans or to adjust, the reality of the operations. The thing I've been spending a lot of time on is just the kind of the emotional toll that some of this stuff takes on the founders and the CEOs that we work with. So we've done a couple of things. I've been connecting all of our portfolio CEOs so that they can actually share stories and in some cases support. As an investor, I also realized that, I can be someone to talk to, but I'm not always the first choice for a CEO if they want to talk to somebody. So sometimes the peers are actually just really helpful. So we've been focusing on that. In some cases, helping them to make some of these changes. We've got a couple of first-time CEOs that haven't had to go through a downturn like this before. And, it's really tough. It affects everybody. So, we're trying to do that. I think we're also trying to help in some cases on some business development, but a little bit more just on the personal piece of it in the short term, at least. I think like Dovi said, we did the plans quite a while ago, but executing the plans actually is a challenge. And you've got people adjusting to working from home. You may have literally let go of 40% of your staff over the last few weeks. These are massive changes for a couple of these companies to deal with. So we're trying to just kind of help them through that.
Thank you. Great answers, and really, I think great tools for all of us, especially entrepreneurs that are facing those challenges for the first time and only saw only heard the music sing until now, so it's a big change for many of them. And thank you for this reply. Last question that I would ask quickly, and maybe we can start from you, John, coming with a corporate background, if you will. What do you think about M&A activity at this time? We did see some news in this regards last week. Plenty of cash for some companies, maybe some fire sales. Where do you see this developing?
Yeah, so I can actually talk from a couple different points of view, I think. So I do think there's an awful lot of companies that are sort of, one of the simple reactions for a big company is to freeze budgets and to say, okay, we're going to go on hold for a while and see what happens. So I actually have two companies that are in the middle of M&A, one that I did as an angel a few years ago, and then one in my portfolio right now. In one case, the portfolio company had 5 offers or 5 companies that were in bidding 3 weeks ago, and that's now down to 2. Although I will say there was sort of this knee-jerk reaction from everybody to say, okay, we're kind of out of the market and we're just not doing anything. And now I think as things have sort of solidified a little bit, or people are starting to see, okay, there will be an end to this, and things are coming out, the discussions are starting back up again a little bit more slowly. So we are seeing that. I think we're going to see a pretty big drop off in Q2 in M&A, which kind of makes sense. There's this knee-jerk reaction, but I do think that there are companies that are seeing, just like investors, that this is actually a great time to be in that market. So I do think we're going to see some transactions. I don't know what the prices will be exactly. The other thing I've been telling people, and this works for biz dev too, is I've got another company where everything is moving probably 10 times faster than it was maybe 4 weeks ago. And I think the other thing that people need to recognize is you've got a whole bunch of people now that they might not have the budget sitting there today, but they have a lot of time. They're sitting in front of Zoom, they're sitting at home, they don't have a bunch of other activities occupying their time. And so for biz dev, for M&A, for relationship building, it's actually a really good time to be getting yourself in front of people who are relevant for you. And in some cases, I think, M&A, at least the kind of nuts and bolts of it, can move pretty fast because people don't have as much to be working on.
Thank you. And I think this concludes our session today. Thank you both for sharing all this information and view that's based on tuition paid and lessons learned over the past years. I know it was fascinating for me. I could have stayed on the line for an hour now, and I'm sure it was the same for our audience. I want to thank again Guy and SOSA, Global Cyber Center of New York, as well as ZAG, our partners for SOSA. And I want to thank you, Dovi and John, for this fascinating talk. And I want to thank my kids for not running into this room for the past 45 minutes, which is a big relief. It was close a few times. Thank you again, and enjoy the rest of your day.
Thank you.